And welcome back. And we're moving into a conversation this morning discussing the newly restructured SuperBond. And we have with us at this time economist and attorney at law, Christopher Coye. Good morning and welcome.
Thank you.
Now, I think there's a lot of information to be able to go through in terms of understanding the SuperBond. And I want to start off by just being able to get your reaction as to what you think of the SuperBond 3.0, as we're calling it.
Well, the first impression, not looking into the details, you might think it's not a bad deal. The interest rate adjustment from ultimately 6.767% down to 4.9375% would seem to represent a significant adjustment, a significant savings. The reality, though, is that the actual cash flow, the real cash flow that the government will have to deal with doesn't change much. When you look at the cash flow under the SuperBond 2.0 up to the February 2024, understand that the existing bond, this 2.0 bond, goes up to 2038. But right now, for purposes of comparison, we look at from now until February 2034, when the new bond would have matured. Under that scenario, comparing the cash flow under both scenarios, you're looking at roughly $410 million US in interest payable over that period under SuperBond 2.0. Under SuperBond 3.0, you're looking at roughly $403 million in interest payable. So that means you're basically looking at a savings of $7 million in actual cash outflow, a savings of roughly $7 million over that 17-year period. If you had continued from 2034 to 2038 as the existing 2.0 bond continues to maturity, there would be an additional interest payable of roughly $16 million. So even if you look at it to that extent all the way to the maturity in 2038 of the 2.0 bond, the total cash savings is only $23 million. So it's either 7 or 23, whichever way you want to look at it. But certainly it's not on a net present value basis, nowhere near what any suggestion would be in terms of savings on a net present value basis. The reason you use net present value.
I wanted to get into that. Yeah.
You apply a discount rate on the future cash flows. If I have $100 today, would you prefer to get that $100 today or $100 tomorrow or $100 next year? So there's what you call the time value of money.
Yeah.
And that's how you apply a discount rate.
Yeah.
But that
so the value of the money today is different than it would be in 2038, for example. Significantly different.
Most of us would say yes. We prefer to have our money now than down the road. Now, how much more is it valued now relative to the future? That depends on each of us.
The formula you use too.
It's really arbitrary in terms of what is that discount rate that you choose to use.
Yeah.
And so if you use a high discount rate, then the net present value savings becomes more. If you use a low discount rate, then the net present value savings is less.
Yeah.
Like I said, that's an arbitrary choice of a discount rate that you can use to basically say, well, I saved a lot or I didn't save as much.
This is a significant point because when we look at the negotiation process for this latest restructuring, there was a bit of a stalemate on the first proposal, and one of the main concerns coming out from bondholders was that the net present value would have been about 40% less.
Right.
Now, just very quickly, in terms of looking at how the negotiations unfolded, and now the first proposal really doesn't matter for much because it wasn't accepted. It was essentially kind of waiting for the other person to blink first, right?
Mm. Well, I think of negotiation in general as somewhat of a poker game. Mm-hmm. You're looking for the other one to blink. You're looking for the one. You're trying to size up the other person, get as much information from that other person as you can, because that allows you to make a better decision. Information is key. Mm-hmm. Sometimes the other side may wish to make a bluff, mm-hmm. and you have to decide whether, based on your interpretation of that other party, whether you will give in or call on that bluff. Mm-hmm. In this case, with the original proposal, certainly that original proposal with a 4% interest rate adjustment would have been great for Belize, not so much for the bondholders. However, the bondholders have certain information on us, on our fiscal position, on our economic position, on our reserves. So with that proposal, the government can say, I'm proposing this to you, and it may be that I won't or can't or won't pay the next interest payment. Now, to the bondholders are looking at it and say, but you have $350 million in foreign reserves. You can't pay $13 million. I don't know if I will believe that mm-hmm. you can't pay, so maybe you won't pay. But if you won't pay, what's the effect of not paying? Mm-hmm. Well, I think all of us know that the existing 2.0 bonds have a clause in it called the principal reinstatement clause. Mm-hmm. And in that, what that clause says that is, if you don't make that interest payment, if you make a default, then the original principal becomes reinstated, mm-hmm. and so we add on $55 million onto our bond debt. So do you want to take that risk? Do you want to increase from what, $525 million in SuperBond debt to another to $580 million or $570 million? That's the question. So for me as a bondholder, knowing that and knowing exists. Your financial position, which you have been obliged to disclose, should I give in to that original bond proposal? Mm-hmm. I would think not. And so what do you see follows from that? Yeah.
So they held out
a blink.
Yeah, yes. Until there was a new proposal, which seems to have been significantly different for them to be able to accept.
Yes, it's useful to have an idea of bondholders. Who are the bondholders? Mm-hmm. I don't know who the bondholders are, but at least I know that these bonds are tradable bonds. Mm-hmm. And as tradable bonds, anybody can be a bondholder and can buy and sell these bonds at any time. So if you're buying and selling at any time, you can choose to be in at any point in time, wherever the price of that bond might be, and deciding on what risk you might want to take in terms of buying that bond. The value of our bonds has varied significantly over the years. I guess original or par value of the bond would always be 100% or a dollar for dollar. Mm-hmm. But based on the market's perception of the likelihood of repayment of the bond and the yield, the return on the bond, the price of the bond might vary or will vary. For the most part, Belize's bonds have been between as low as 41 cents on the dollar and as much as 90 cents on the dollar. But for the most part, in a range of between $50 and $70. So when you look at that, the question arises, the bondholders that are there, how many of them bought in at a reduced price? So if I bought in, and as late as January, the bonds were at around 41 cents, in the low 40s on the dollar. But even, let's say, moving back a year before, you're still only between $50 and $60. You could take a position that, guess what, if I buy in now at low 40s, right now the price of the bonds is over 50 cents on the dollar. I have basically made already in 2-3 months 25% return.
Because of the increase in value.
Right. Yeah. So bondholders, you can't look at them as saying they bought in at 100 cents on the dollar. They could have bought in at a much reduced rate. So there's a real question as to whether these bondholders, in fact, are losing or actually gaining quite a bit. So it's useful to have that appreciation of where the bondholders are, to understand their willingness to negotiate, because they might be making 10% as opposed to 20%, but they're still making 10%. They're not losing.
Yeah.
So that's understanding how the bond market works and how our bond market operates in that market.
And you see that it's quite very much so a numbers game in certain regards. But when you look at the SuperBond 3.0 as it is now, and you look at the one before, you wanna have this perception that there is much so a strategy to the whole thing, negotiation, all of this. What do you think would be some of our secret cards, our kind of bluff that we could throw in? I
don't know that we have that anymore, or that we ever did have. If you look at the bond instruments, the terms of the bonds, and even on a state level, you're supposed to have full disclosure. We're under these bonds obliged to give full disclosure of our financial position. So there's no question of predictability or unpredictability. They know where we stand. So because of, like I said, information is key in terms of negotiation, and they have information, then it puts us in a naked position, if you will, that we have no choice other than to negotiate with that open, frank disclosure.
But do we go to the table? Do we go to the table with this very kind of defeatist mentality that, we have all our cards showing, we have no real secrets to display? Do we go with that mentality? What would be our strategy then, knowing that they have the upper hand?
I think it's a matter of understanding the bondholders, where we are on a basis of good faith, in terms of being able to negotiate that our real position is what it is and we can't do any better. If we can't do any better, how can they squeeze out more? So I think we're in terms of negotiation, it's not so much that we could do much better in our negotiation. It is what it is.
Yeah. Okay. The financial situation was very clear. Now, I want to look at the purpose behind the restructuring, and it was more of a long-term vision. One of the things that was that was a part of SuperBond 1 and SuperBond 2 was looking at the interest rate, the changes in the interest rate that would have taken place. They call it the coupon. And essentially, as time progresses, there was an increase in interest rate that would take place. We're not seeing that in SuperBond 3.0. And I want to talk about what that means for Belize's economy and being able to make the payments as we move along.
Again, well, the SuperBond 2.0, SuperBond 3.0 discussion, I think, really pales in comparison to a discussion on our economy, the state of our economy. We have shrunk over the past 2 years. We're clearly in a recession. the expenditures on the nationalization payments, they have had an impact on our foreign exchange reserves. Our unemployment rate is over 12%. So our economy itself is sick. We really do have a problem. The effect is that, as the financial secretary has alluded to, is that there needs to be fiscal consolidation, fiscal adjustment. What that means? That means taxes. There's an increase in taxes on the horizon. What that means for expenditures. There must be a cut in expenditures, and that is when you start looking at what is it that these bondholders, in these other clauses other than interest payments, what is it that they are calling for, and what are we committing to? Primary surplus. What does that mean? Primary surplus, according to the IMF consultation report and figures, we haven't had a primary surplus since 2011 of 2%, of over 2%. We have had primary surpluses of 1.4, 1.1. In 2015, I believe it was a negative 5.6%. And in 2016, we're expecting that might be zero or negative. So we are suffering from a deficit. What that means, and what is a primary balance or a primary surplus? What that is the government's revenues minus the government's expenditures, excluding interest payments. So they look at that because it directly tells you if there's a surplus, can they make the interest payment? So that's what the primary surplus is about. So to say that the primary surplus is going to be 2%, that will give them comfort that they will get paid. Now, in our case, we haven't been able to get a surplus over the last couple of years, much less 2% over the last 5 or 6 years. So that will be a challenge for us.
And I appreciate you pointing that out, because a part of the commitment that is made in this newest restructuring is a primary surplus of 2% for 3 fiscal years.
3 fiscal years, 2018, 2019, 2019, 2020, and 2020, 21. So we have to move to that. And how do we get to that if we haven't been getting that? In fact, in the years projected, the IMF is still projecting negative 2% or thereabouts in primary deficits. So how do we turn around and get to that? It's not complicated. We have government revenues, government expenditures, excluding interest payments. So government revenues has to go up. Government expenditures has to come down to switch it over.
So very simply, the country has to make more money than we spend.
No.
Government
has to make more money. Yes, I agree that if we grow faster, that will have an impact on government revenues, because let's say we tax 30 cents on the dollar, which is roughly what we charge, what the government charges us in taxes, and our income is $100 today, 30 cents on the dollar is 30 cents. But if we grow 10% over the next 2 years, then you charge 30 cents on the next 10, and so you get 33 cents without increasing the tax rate. Now, if we're not growing, to get to 33 cents, you have to increase to 33 cents tax rate. So it's important that our country, our fiscal policy or monetary policy is geared towards growing the economy, not remaining stagnant as we currently are.
There is not only the commitment to be able to reach the target of the primary surplus for 3 years, but they're also asking, I know the bondholders are interested in the commitment by government to introduce a statutory instrument within our laws to commit to that.
Yes.
What does that mean, and what would be the impact of that? How does one make a statutory instrument to do something that we have not been able to do for years?
Well, that's a good question. I think all you can say is say that you will do it, and saying it as a matter of law, because as an SI it is a matter of law.
Yeah.
But I'm not clear on what are the repercussions if you don't comply, other than the reference to IMF for technical assistance.
Yeah.
So it's an assurance.
Yeah.
It's an assurance by the government to the bondholders that you do plan, and you're showing it manifestly that you do plan to follow through with your commitments.
Yeah.
But it's the proof is in the pudding, whether we will have a primary surplus.
Yeah.
Now, if you set that stage that I am committing to this, then what? And I think it's specific in terms of fiscal strategy statements, medium-term review reports, etc. If you follow through with that, again, it's a disclosure. It's disclosure of information, keeping the bondholders informed as to what steps are being taken by the government. But they will want to see a follow-through.
Yeah.
In reality, what this is, as much as we are fearful of the IMF and an IMF standby program, this is in large part a bondholder-induced austerity program already. We are committing to a 2% primary surplus, so that means we have to find ways to increase our government revenues and reduce expenditures.
Sorry.
Go ahead.
Do you think that when I look across the Caribbean and we look at the kind of economies they have, very similar in terms of the way that we earn revenue, do you think that our economy is at a point right now where we can kind of put the foot on the gas and just speed it up to the point where we're increasing government spending to promote private sector investment and all these things? Are we able to handle that as well? Will our people understand the dynamics of that kind of economics?
I could probably talk another hour in responding to that question. There are so many things that you have to factor in, have to consider as you look at trying to grow our economy. We're not unique. Every country in the world is trying to grow their economy. So what are the decisions we have to make? It really isn't rocket science, but it doesn't happen overnight. When you look at successful countries, what they have done, we don't have to reinvent the wheel, but what it comes back to is our education and literacy, those basic things that our population needs to benefit from, so that they develop the skills to be productive. It is about productivity and at the individual level. So that is a medium to long-term solution. On the short-term level, you have to look at how do you bring back or build investor confidence. A renegotiation of a SuperBond does not bring back investor confidence. A bondholder is actually an investor. He's a lender, but he's an investor in Belize. Just as an equity investor is an investor in Belize. So when you renegotiate and take and seek to change the terms of their investment, that doesn't bode well for others to invest in Belize. Just the same as the nationalizations. Those are investors whose assets, whose investments were nationalized. So how does that bode for investor confidence on a whole? So we will have to embark on an ambitious effort to build investor confidence to invest in Belize, because Belize does have opportunities.
Of course.
But you need to feel confident that when you invest, the platform is clear, the playing field is clear. I will have a fair chance to make a return on my investment.
Now, I think one of the points you were speaking about earlier is one that we do have to discuss further, and that is the role of the IMF in this. And this is very clearly included as a part of the latest restructuring. And you are right when you say that Belizeans, or people in general, tend to get nervous when you talk about the IMF coming in or imposing regulations or restrictions. Let's talk about, and this is, as we understand it, a part of the clause that if you're not able to make your payments, if you're not meet your fiscal targets, then you will move to this. What would that mean? What would that include?
Well, so far as these proposed revised terms are concerned, it is not talking about the IMF coming in with any kind of standby arrangement.
Yeah.
It's simply talking about the IMF providing technical assistance, advice. So there's no I would, although the word IMF is in there, I wouldn't say that means, there's a standby credit arrangement looming.
Yeah.
It is about technical assistance and advice, at least under the terms of this bond. The IMF comes here every year.
And we get recommendations
our
from the IMF
Yes.
each year.
They assess, analyze the state of our economy, the state of our banking system, our financial sector. They look at our picture overall, and they, from that assessment, make recommendations. Some of the recommendations actually have already been implemented. Just from what they have been recommending last year, you will see that, and we have all experienced the substantial rise in taxes on fuel. I think just on the news report last night, and the price of fuel went up again. I think if you look at the effective tax rate on fuel, it jumped from roughly 30% to just about 50% over the last year and a half alone. So that's where a lot of the additional taxes is already coming and will be coming from.
Now, I want to ask you, as an economist, when we look at what is being proposed at this time and what is accepted by the bondholders in terms of Belize's commitment, the government of Belize's commitment to change what we have known and understood to be a long-standing trend within our economy. What are the opportunities that exist in being able to get us there? And what are some of the major changes that we as Belizeans would have to see? And I know I'm putting you in the position
Get us where?
To be able to meet the surpluses, to meet the fiscal targets, to be able to ensure that we can keep up with the payment schedules that is set out in the SuperBond. In other words, we've gone back to the table. This is the third time. We know we talk about GDP growth, we talk about a recession, we talk about all the different challenges that we have. In other words, with this latest restructuring, we're committing that we can do something about this. And what can people expect if we are really going to be able to do so?
In the short run, looking at these primary surplus commitments, I think we have to get back to the reality. This is a fiscal debt. This is not the entire economy. This is not you and me, although we are we pay our taxes to the government, so it will come out of us ultimately. But it is a fiscal debt, so to be able, so it's the government that has to come up with the funds to pay this debt. Given the commitment on the primary surplus, the expectation is that there will be increase in taxes, there will be adjustments to expenditures. And again, alluding to some of the comments from the financial secretary, when you look at what he said about expenditures, that there's rigidity, which is saying, in other words, I can't make much adjustment on that side. But in using the words again on government revenues or taxes, inevitable means, okay, well, it's coming there. So that's what we have to expect in the short run.
Now, one of the things that we hear very often from civil society and, of course, from other political parties is looking at cutting government expenditure, cutting the fat. That's what they call it. In other words, there's an assumption of wastage that takes place that perhaps if we reduce that, we'll have more money. Is that also a part of being able to change your financial position?
I think there's a number of suggestions in the IMF, the last IMF consultation report, how to adjust on the expenditures. One is to public procurement. Public procurement. One is wage freeze. Another is what they call attrition. For every 2 persons employed, you basically lay off 5. So obviously those will have an impact. Certainly it will improve the government's position fiscally, but what will be the impact on unemployment? So those are the challenges that you'll be forced to face.
I know it's kind of early to tell right now because we're just 2 seconds in, but what do you think would be, at surface value of course, some positive gains from the restructuring?
I think the good and bad is that it forces us to look at where we are, the financial position that we face, and how do we tackle that now. Now, if we're going to be prudent about this exercise and really paying off this debt, then we have to not, we can't look at just next interest payment or next year's payments. That's going to be lower for sure because of the interest adjustment, but we have to raise the capital for when 13 years down the road we have to come up with 105 million every year in sequence. That just doesn't come out of the air. So in other lending arrangements you develop a sinking fund, and so you start taking out from now. Sterilizing funds, setting us aside. I think the municipal bond is an example, the Belize City municipal bond. That's what they did. And that's the norm. So you pull out funds to build up so that you are able to make the payments, and that's why it's a heavy cash flow requirement. Under the SuperBond 2.0, when you look at the life of the bond, the average cash flow requirement is US 22 million per year. Under this 3.0, the average cash flow requirement is 26.5 million per year. So the average cash flow requirement under this revised bond is actually worse for us until maturity. So it's going to be a challenge. Let's just put it lightly.
Now, in conversation yesterday, we had in the news last night a interview with Charles Blitzer talking about the SuperBonds, the bondholders' perspective on the latest restructure. It seems very optimistic. I want to be able to move beyond just looking at having restructured the deal and kind of just take one overall look as to what this means long term. I think you very clearly defined that there is going to be a higher cash flow necessary to be able to make payments on a yearly basis. We know that when the end draws near, there's a larger payment that has to be made. What are some of the things that people need to understand today about what this means for the long term?
That we don't have any economic largesse. We have to be prudent, we have to be frugal so far as our expenditures are concerned. We need an enabling environment for the private sector at the same time. I think the private sector has struggled over the past several years. With increased taxes, it would probably be even worse. So we have to be creative in terms of seeking to impact on growth rather than to build tax revenues rather than just simply to increase taxes. But efficiency is what it will ultimately, efficiency and productivity. We have to build in productivity within our economy. I think if you look at the numbers for productivity, we have been erratic, but on a downward slope in the last couple of years. So productivity is a key area that we need to focus on from a policy standpoint. Efficiency, the way we on the government side, we do our collections, the way we do our expenditures. We have to make sure we squeeze out as much as we can out of every dollar that we spend.
Okay. Right. Yeah. Anything else you'd like to say before we close?
I guess one of the comments I think would be useful to appreciate is when it comes to the SuperBond, from the time that you had SuperBond 1.0, which was around 2007, to now, we have paid over or about $250 million in just interest. In Belize dollars, that's $500 million. What has been the effect on the amount owed, the principal owed? We haven't done anything on the principal owed. The principal owed, $526 million, has been there for what, at least the last 4 years, and will be there for the next 13 years before principal is paid down. As much as we have a reprieve, a short-term cash flow reprieve under 3.0 relative to 2.0, at least under 2.0, we would have been paying down some of that principal. What we need to then focus on is trying to pay down that principal, even to the extent that, and we didn't talk about this, but even to the extent of buying back, as we are able to, buying back the bonds pennies on the dollar, going into the secondary market and buying back pennies on the dollar. It will be an investment worthwhile for us, rather than waiting until the end when we have to come up with the full principal amount to pay off our debt.
Okay. Well, I think that we want to thank you so much for this very comprehensive conversation. I think a lot of people are now better engaged and aware as to where we stand and lessons learned. Thank you so much, Christopher, for being here.
Yeah.
Thank you very much.
We're going to take a really quick break, and when we come back, it's to talk to representatives from the National Women's Commission about International Women's Day. So stay tuned.